Welcome to The Explainer. We are jumping right into it today because we're breaking down the absolutely critical August 17th through 22nd trading setups for two of the biggest heavyweights on the board, the EURUSD and the US Dollar Index, or DXY. Look, whether you're actively trading these markets right now or you're just trying to wrap your head around the current macro environment, this explainer is designed to give you the exact structural map you need for the week ahead. So, let's get into it.
Okay, here's our agenda for today. We'll kick things off with the inverse correlation macro driver, move right into the DXY bearish blueprint, and then tackle the major resistance facing EURUSD. After that, we'll map out specific buy setups, the sell setups, and we'll wrap up the whole thing with strategy and risk rules.
Starting with Section 1, the inverse correlation driver. Understanding this specific relationship is literally the foundation of our entire trading plan this week.
I want you to think of the EURUSD and the DXY as two kids sitting on opposite ends of a seesaw. Right now, the prevailing bias is mildly bullish for the euro, and we've got a bearish trajectory for the US dollar index. And this brilliantly illustrates how DXY weakness directly fuels EURUSD strength. We're looking at a market environment where the dollar trending downward, specifically targeting levels below 100.50, is basically providing the necessary oxygen for the euro to thrive, with buyers eagerly stepping in on dips above that 1.1500 level.
But you gotta ask, why is the dollar on the back foot in the first place? Well, the recent decline didn't just happen out of nowhere. It was driven by three very specific pieces of data. We had weak July US retail sales, we saw softer than expected inflation data, and because of that, there are significantly reduced expectations for another Federal Reserve rate hike coming up in September. These are the fundamental weights that are currently holding down the dollar's side of the seesaw.
Moving on to Section 2, DXY, the bearish blueprint. Now that we understand the why behind the dollar's weakness, let's map out this decline technically.
99.67. Go ahead and lock this number in your brain right now. This is where the DXY recently closed, and it serves as our definitive starting point for mapping out the bearish landscape this week. Honestly, the very fact that we are closing down in the 99s just goes to show how much pressure those macro factors are exerting on the greenback.
Looking at the battlefield from that 99.67 close, if the dollar tries to push up, it's going to immediately slam into resistance at the psychological 100.00 level. Beyond that, you've got 100.50 and 101.00 standing guard. But looking downward, which, remember, aligns with our bearish bias, the immediate floor is right there at 99.50. Now, if that breaks, the trapdoor basically opens down to 99.00 and potentially all the way to 98.50. These zones are absolutely vital because they frame every single one of our upcoming trade entries.
Section 3, EURUSD, approaching major resistance. Shifting our focus over to the euro, remember that seesaw? With the DXY acting weak, the EURUSD is naturally catching a bid, sitting pretty right around 1.1564. So the bias is mildly bullish, but guys, there is a massive obstacle dead ahead.
1.1600. This right here is the ultimate line in the sand for the euro this week. The EURUSD absolutely must conquer this exact level to validate any deeper, sustained bullish momentum. Until it breaks and actually holds above this number, the bulls are technically still on a leash.
So why is this zone so incredibly tough to crack? Well, it's not just some round psychological number. That 1.1600 major resistance is heavily reinforced by a cluster of immediate resistance right below it, sitting between 1.1565 and 1.1570. And the reason for that is the 100-day simple moving average is parked right there, specifically at 1.1567. A decisive daily close above 1.1600 is exactly what the bulls need to clear that 100-day SMA and really strengthen this entire setup.
While 1.1600 is our ceiling, we also have to define our floor. Below current prices, we've got immediate support at 1.1525. Below that, strong support sits at 1.1500. The absolutely crucial point here is that if we see a daily close below 1.1500, the weekly bias flips entirely from mildly bullish to distinctly bearish. That would expose a drop to major support at 1.1460 and maybe even down to the weekly support at 1.1420.
Okay, Section 4, trading the buy setups. We've done the macro work, so now let's turn this into some actual actionable trading parameters, starting with the long side of the market.
The risk-to-reward dynamics on these setups are just highly controlled, which is exactly what we want. For a standard EURUSD buy, we're looking for an entry on a dip, right between 1.1530 and 1.1550, keeping a tight stop loss at 1.1490. That is a brilliantly tight risk parameter when you factor in the multi-level take-profit targets of 1.1600, 1.1640, and 1.1680. Now, alternatively, if price just surges right past our line in the sand, there's a breakout buy setup, you enter above 1.1600, put your stop loss at 1.1555, and target those higher 1.1640 and 1.1680 zones.
But what about buying the dollar? Listen, I want to be incredibly clear here. We're using some strict conditional logic. We only consider buying the DXY if, and that's a massive IF, it establishes firm support down in that 99.00 to 99.50 zone and explicitly reverses upward. If and only if that condition is met, an entry between 99.10 and 99.40, protected by a stop loss at 98.70, gives you a ladder of take-profit targets back up through 100.00, 100.50, and 100.10. But again, you absolutely must have that confirmed reversal.
Section 5. Trading the sell setups. A great trading plan isn't about having a crystal ball to predict the future. It's about preparation. We need a solid plan, no matter which way the market breaks.
So, let me pose a scenario to you. We know the EURUSD is mildly bullish, right? But what if it hits that 100-day simple moving average in the 1.1565 to 1.1600 zone and the sellers just completely overwhelm the buyers? What if that line in the sand rejects strongly?
Well, if that happens, here's exactly how we capitalize on that rejection. We look for a EURUSD sell entry right up in that rejection zone, between 1.1570 and 1.1590. We place our stop loss cleanly above the fray at 1.1625. And as the euro falls away from that ceiling, we scale out our take profits at 1.1530, the critical 1.1500 level, and all the way down to major support at 1.1460.
Now, what's really fascinating about these setups is how the DXY sell setups align perfectly with our primary bearish macro thesis. If the dollar rallies to the 99.90 to 100.20 zone and rejects, bam, that's a sell trigger. Stop loss at 100.60, targeting those supports below. But check out the second scenario, the breakdown sell. If the DXY cracks below 99.50, it literally accelerates the bearish trend. You can enter below 99.50 with a tight stop at 100.00 and ride that momentum down to 9900 and 98.50.
Final section, Section 6, Strategy, Risk, and Confirmation. Let's synthesize all of these drivers and blueprints into our rules of engagement to keep our capital safe.
Distilling this whole shebang down, these are your highest probability scenarios for the week. For EURUSD, we prefer buying on dips as long as we stay above that critical 1.1500 level. For the DXY, we prefer selling on the rallies as long as price stays below 100.50. You can never forget that these two setups are naturally linked by that seesaw effect. If the DXY suddenly manages a recovery above 100.50, it completely blows up the probability for the EURUSD, making it way more likely that the euro will fall back toward 1.1500 or 1.1460.
Knowing the levels is only half the battle, right? Execution is the rest. So here are your strict rules of engagement. Step 1, wait for a confirmed 1-hour or 4-hour candle close before entering. Seriously, don't front-run the market. Step 2, always check your actual broker spread. A wide spread can instantly ruin a perfectly good entry price. And step 3, execute the entry and most importantly, respect the stop loss. Having the patience for time frame confirmation is exactly what separates wild gambling from true, structured trading.
I want to emphasize this point heavily. These are technical scenarios, not guaranteed signals. We're out here mapping probabilities based on historical data, moving averages, and macro drivers. Smart traders don't look for guarantees. They manage risk based on data. Those stop losses provided, they are there for a reason, so please use them.
So I'm going to leave you with this thought. As the market opens, with the EURUSD sitting right at 1.1564, staring down that 100-day moving average, will the euro find the strength to conquer that 1.1600 line in the sand? Or will the US dollar index finally find a floor, rally past its resistance, and completely flip the script on this week's technical map? Watch those charts closely, stick to your levels, and let the market show its hand. Thank you so much for joining me for this explainer, and I'll catch you next time.